Still quite quiet. Feel free to present yourself. It's my first time coming around at TechUp. Let's wait another few seconds and we'll start. I mean, I'm sure it's warmer than where I'm in France, so it's finally getting, acceptable for mountains. Yeah, I have the opposite problem. I constantly eat. I come from mountains, so that's my natural place. I prefer cold to eat. Cold is far easier to deal with. Okay. Wow. Okay, let's start this session. People will come in and they can jump on the one going. So, okay, everyone, welcome. I'm Thomas de Pierre, as you can see here, and today I'm here to talk a bit about venture capital and how it works. And so before we go deep in, right, and why still verifying that I have everything set up, if you have any question during the whole thing or something you think is important to say or anything, like feel free to talk in the chat or to put it in QA. QA is probably the better place for everyone, but just talk with each other in the chat. I will read it during. This is probably going to be interactive. Otherwise, there's going to be me talking a lot, and I like to do that, but that's not fun for anyone. So VC in tech. So why even talk about that, right? That's not directly what we do at TechUp and all. Well, the reason is because, or at least why I like to look at it, is for two reasons. First, I am recently trying to found something, and so I have to look at what my options are. And there's not that much. And VC is fundamentally the only one you have access to in software, more or less, if you want to build something. And if you want money, at least. And the reality is that that means that you build what you can get funding for. And so if you want to be able to build something and get some money for it and try to, spend time on it while being paid, which is better in general, you don't have a choice. You have to check what VC venture capital is ready to pay for, because that's what you're going to have to search. So you have to look at it. And I'm the kind of person that look at it from a systemic perspective, and having such a bet, I am in an interesting position to talk about this now. So today, I want to present three big parts. First, the technical definitions of what a VC are, like practical, legal, simple things. Then we'll go into something more theoretical of how it should work, how people say it should work and it works. So it's the theory part, right? The stories we tell to ourselves in the media and everywhere. And then we look a little bit at what it look really like in practice. What are the results of VCs in terms of pure real data, and what does that mean? Now, before I go too deep in, I'm going to present models, right? And if you have been any close to a lot of engineering, system thinking, you know that all models are wrong, right? They're an approximation of what the real world is. They're a way to try to understand what the world is, but they are always going to have limits. And that's me. And the way to deal with that is to know when you need to move to another model, right? In this case, I'm going to present model. You may know VCs that do not fit this model. That's possible. They exist. I can think of a few. But I'm trying here to define the trends that define the a lot of what we do in software. Okay, so what is a venture capital company? What is a VC, right? So it's a term we use for a lot of things. Fundamentally, a VC is fundamentally a 10 years investment fund. 10, it could be a bit more. These days, it's probably more 12 or 13, but historically, and if you look in the textbooks, it's a 10 years investment fund. It could be less, that's rarer, but basically. And basically, in this 10 years investment fund, you have three big actors, right? You have the general partners, that we will call the GP all around this, because I'm not going to say general partners all the time. The limited partners, the LPs, these are usually investors, people with a lot of money. So you are going to find university endowments, pension fund, hedge funds, money managers for people that have money, charity endowments. These days, you will also find a lot of big, I don't know if you call them debt fund, but you will find big investment companies that handle money of other people in a more passive way. So the money of 401k in the US would end up in these kind of situations. And then you have startups, right? Companies that want money. So in general, VC tend to invest in a broad amount of domains, but software, pharmaceutical company, biotech in general, nuclear companies are big things. They love to spend money in energy. Space company recently, even more, are the kind of companies they usually look at. And the way this works is that the limited partners, the LPs, put money into this 10 years investment fund. The GP manage that fund for these 10 years. So they decide who to invest it in, what type of what company will get that money, when you get it back, when you maybe give it more to the company, they manage it. And the startup gets the funding from this 10 years investment fund. And a thing is, this is not a single fund, right? Usually the same general partners will have a fund that they created a year or 2 years before that is already running, and they have closed, so they do not accept money anymore, and they have created a new one, which is a current one where they want to get money in. And they have future ones they want, right? They are not going to wait 10 years to open a new one. They are probably going to open another one the year after or 2 years after, right? So, and what we call VC in general is this company, this thing of the managers, the GP, that create these funds to get money to invest, right? And that's what we call a VC or organization usually. You will see also the term used to just mean the general partners, because that their life is to be the figure of the VC company. So that's usually, we are going to call them VCs regularly. But really, this is these companies that create this investment fund for money to come in from LPs and to get out to fund startups. Now, that's nice and all, and I've put really pretty colors, but what do we do with all that money? Because once you get money in, you have to have a plan, right? Some kind of a plan. The plan is that you invest money during something called a founding round, right? And you wait 10 years or maybe less than that, and you help these companies that you found until you get to a liquidation event, which is the moment where you can get your money. You can get money back from this investment because this investment is stuck in the company. And hopefully you get money with some markup, right? You made a profit and you return that profit to your investors, right? Sound pretty simple. Funding room has pretty well-defined name. Usually, especially in tech, you will call them pre-seed when you're really early, when you probably do not really have a product yet. Seed when you have a product, but you need to grow your sales. Then Series A, Series B, C, D. It was rare before to have a lot of these, but these days it's not particularly rare to have to go up to Series F, G, L, whatever. Liquidation events are interesting. This is usually where you can get your money back. So when you put money on a company that is in the private market, right? You can't easily buy or sell these shares. It's partly hard to sell them. So usually what happens is that you sell a lot of your shares in a dedicated event, a moment where that happen. And that's what we call a liquidation event. The classical one is an acquisition, right? So you build this company, you invested money in, it grew, and at some point, a bigger company decided that, you know what, at this point, we would really like to have it with us because for whatever reason, it corresponds to what we want to do, or we want to put that in our portfolio, and developing it ourselves is too hard, something like that. And that's an acquisition. Very visible example lately have been GitHub being acquired by Microsoft. An IPO is when you go public, you go to the public market. So you basically go to a stock exchange and you make your shares able to be sold to the public. This has quite a lot of regulatory demands, right? Once you go public, you have to make public a lot of information about your company quarterly and all kind of stuff like that. But it's really nice for the people that invested early because they can sell whenever they want, more or less. There are some limitations, but more or less. You can also just do a resale on the private market. You can try to find a company that do not want to buy the whole startup, but want to buy your shares. That's happened. That's used to be rare. It happens more and more. There is a real market for it, but it's still not a really big market, nowhere close to the public market. And another liquidation event, which is usually when you lose all your money, but happens regularly, is a bankruptcy, right? You did not work out, you could not get more money, you're out of money, you stop doing what you do, and it's a pure loss, right? This is technically a liquidation event because you don't have a share of anything anymore. And technically what happened is that you may, probably not because you will go after all the loans, but if there is enough money left after the loans have been repaid, you may get some money from the sale of the assets of the company. But that's pretty rare for this kind of company. Right. And so hopefully you get your money with your markup after liquidation event. Hopefully. And you get that, right? You get given a little bit of money and you made it grow over 10 years of a really nice tree that generates a ton of money, right? Okay, that's nice. That's a nice theory. In practice, why would anyone put money into that? Because this is putting money in something you have no idea if it's going to work or not, and you don't have disclosure like you have in public. You don't know a lot of details. It's not superb. So why do that? So how do you make sure as a LP that your general partners, your GP, your managers do a good job? That you just give them money for 10 years and they just go party on a boat and they come back 10 years later and like, sorry, everyone went bankrupt. We did nothing. You want money back. And as an LP, you put money into this. How do you make sure that, like, as a GP, you want LPs you want investors to put money in your fund, right? Because that's otherwise you have nothing to invest in. That's your job. So you need to interest them. So let's begin with this one. How do you make LPs want to pick you? Well, it's time to put in the big suit and to go talk with them about, money. Usually this is called an investment thesis. You will also see it called a memo, an investment memo. And usually this is a model of the world of startups, right? How do startups work? How do they fail? How do they succeed? And how we, thanks to this great understanding of all this work, are going to make money within and decide what to invest in. Usually, GPs, VC will try to specialize their fund. So they will say that we'll invest a lot in software, or we invest a lot in tech. We invest in really risky bet, or we invest in really simple bet. We invest in energy, because that's usually, there is a lot of reasons why that's attractive, but usually that's attractive to the LP because they can sell directly to their customers. Hey, if you are really interested in energy, we have the perfect product for you. Another thing that GP will do, if you remember our thing about the plan, it's not only wait 10 years after investing and pray really hard, it's also trying to help the company. The idea being that is that the company, a new company, need a lot of knowledge about a lot of stuff about how you run a company and you sell a product. And the GP, the venture capitalists, have been doing that with a lot of companies. So they should have experience here. They can help them, right? So technically, you could also sell not only that you are good at picking company, but you are really, really good at helping them grow, right? That's a theory. And also, there is also some discussion about what are the best moments to invest. Should you invest really, really early in a particular kind of company, or should you wait later when you are sure they're going to make money? That's a real discussion that happened between different funds. There are funds specialized in pre-seeds. There are funds specialized in Series B, etc. And so, but also, like, do we invest right now in this tech, or do we wait because now there is too many investors and not enough interesting things? There's a lot of other things we could add here, but that's a general thing, right? Now, that's basically, this is not an investment. This is a story you tell to your investors. And you are going to try to tell it in a way that they really, really believe your story, because that's what you want. If they believe your story, they're going to give you money. Lot of money, right? Right. But if you remember, this money is invested in the company. So as a GP, how do you make money? And as an LP, how do you make sure that your GP do the things correctly, so they take good care of your money? This is done through, so there is definitely two different aspects here. On one point, the LP want mostly the GP to be rewarded if the money become big, right? If the fund is well invested. On the other side, as a GP, you just want as much money as possible, right? That's what you always want. So this is solved with something called 20-on-2, and that's more or less, even if things get more complicated in practice, but more or less the model followed by most VC. The way it works is that the GP get 20% of the profit at the end of the fund. This is called a carry, right? And that's happened at the end of the fund, when it's closed, when you finish liquidating all this company you invested in. So you invest in the first 2 years, and at the end you sell all of it in liquidation events, and you get money back, and they got 20% of the profit here. There are limits. You need a minimum profit. There can be a maximum to that, but basically this is 20% of the profit. This basically is a success fee, right? If you're successful, you get money in 10 years. There's also a purpose two. There is also a 2, and the 2 is 2% yearly, every year, of the fund value at that moment. So that's based on the mark-to-market value, which means the value of what the fund own at the moment the fee is calculated, right? This is basically a management fee, right? It's every year we pay you a fee for doing the management. It's basically a salary of kind. And the 20% can be seen as a profit. And that's basically how you're going to pay your secretary, how you are going to pay your partners every year to do the basic stuff. This is the bread and butter, right? Okay, so what do one of these investment theses, now that we know how all this stuff works, right, in technical term, in really basic things that are written down on the legal aspects and the financial aspect, let's look at how the mechanics and the theory of how all this works in theory. And so let's look at how an investment thesis work in theory, and what is in general the investment, the things that are shared, the view of the world is shared by nearly all VCs. I'm going to present a really generic one. There is a lot of ways to change it and modify it, and every VC would have something different. But nearly everything I'm going to say here is a shared knowledge, a shared common knowledge for most of the people working in Silicon Valley with VCs. Right. So we remember that's what we do, right? We have general partners that manage an investment fund, that limited partners put money in on the basis of this investment thesis, and this money is invested into startup to hopefully make money. Right. Okay. How does a tech startup work then? What is this investment thesis? So the basis in which VC take decisions, the model of the world in which VC take decisions, is mostly considering that tech startup are capital heavy. What that means is that you need to invest a lot of money into it for it to work. If you invest not enough money, even if you have the best product ever and the best team ever and the best work ever, the best business, it will not make money. You need to put a lot of money into it because you need to build the software that takes a lot of time, a lot of effort, a lot of people, and then you need to keep it running, and you need to sell it, and you need to market it, and that's really hard. That costs a lot of money. That's something. The thing that's what capital heavy means. But it can be highly profitable because software, especially with internet now, can touch a lot of people, right? Historically, if you open a shop, you are limited to the people that can come to your shop and visit it. If you open Amazon, you don't really have a limit anymore. The whole world are the people that may pay for you. So that's the way they think usually. So to make profit, you need to scale. You need to be able to serve all these people that you can, but you need to be able to do that, which explains the capital levy. Another thing they add is something called the network effect. This idea is that the more people, as you can touch a lot of people, the more people are buying your stuff and doing your stuff, the more people will do it because you will grow, you will be visible, and you will get something, you will get an advantage here. Well, that means that basically the thing, there is a winner take all situation. The most influential competitor will beat all other competitor. It's a monopolistic situation all the time. There is a lot of theory behind that, and there is a lot of people that sell this as a really important part. And that means that the first company to enter has a big advantage because you got people in first, so you have an advantage in terms of networking. So you get a moat, a defense against competitors because you already have this effect for you. Which means that you need to scale faster than your competitor, which means that you need a lot of money faster than possible, as fast as possible, because that's what you need to succeed. Because growing costs money. And what that means is that you will need to spend every single penny you have into growing faster because you want to be the faster, because if you are a bit slower than anyone else, they're going to win instead of you and they're going to get rid of you, right? It's a winner take all. So profit do not matter unless you have already won. Profit only matter when you're monopolistic. And that's a really monopolistic situation in theory. But what that also means is that there is a lot of failure because you are going to spend all your money into trying to get more people than anyone else, but without making any profit. So if at any point you run out of money and you cannot get more from investors, you have no profit, so you have no money. You're out of the business. If you don't go fast enough and someone else go faster than you, winner take all. People aren't going to give you money anymore because this is not worth it. You are losing. Right? This is not only monopolistic, this is monopolistic by this mechanism, but it's also monopolistic by the financing. Because if you are not the best in class anymore, you are not the first, you are the second or third, you are spending money without any profit, and no one will want to keep financing you because there is nothing to win. Right? But if you win, there is a lot of profit. Right? And that's basically the way VC think. Right? Lot of failure, lot of failure, but you can make a lot of profit if successful, which means you don't need a lot of profitable, you just need a few, and that will compensate for all the failures. Okay. So that's nice. Now let's look at, for the LPs, how they think. The LPs need a VC fund to return approximately 10% per year. That's the reality of it. The reason for that is because you need to beat inflation, right? Because inflation makes money worth less. So you need 10 years of inflation beaten. And you also need to beat the market index. If someone decides, instead of investing in the VC, to just buy all the S&P 500, they are going to make approximately 7% per year. That's approximately what have happened for the past 10 years, and a bit more than that. So you need to beat both inflation and that. And the fees, because the fees goes on top of all of that, right? So you need to make 12% because you need to bring back more than all of this combined. That translates over 10 years, you need to make 3 times as much money as you got at the beginning, right? Every dollar that was invested by LPs at the beginning need to be $3 at the end of 10 years. Otherwise, you lost their money. You lost some of their money. So if there is a high failure rate, we need the success to be really big because we need to do a 3x knowing that a lot of them will fail. So we need the ones that succeed to be at least 10x to compensate. Okay. That was the theory. That's what we want. We want to bet on a lot of companies, and with some of, with trying to hedge our bet by being better at deciding which one. And we want them to succeed, a few of them that succeed, and to succeed amazingly well. And we think that will be rare, but that tech, by definition, is something where a lot of company fails and the few that succeed are really big. And that's why VC like tech, right? Because tech is exactly, the way they think of tech is exactly what they need to make money. A lot of failure with a lot of money needed at the beginning, but when you succeed, you make a humongous return. Okay. In practice, does it work? Well, there is 3 things that need to work here, that need to be right for this thesis to be right? Company need to be able to transform into ones that make profit. That's a given, because you need at some point to be able to make money, right? To be able to be worth that much. So even if you lose all your money now, you need to be able to make a lot of money later. You need to return better than the market index, right? You need to do your 12%. And a lot of failures need to happen, right? Because that's the basis of the theory. Right. So let's look. Do we have a lot of failure? Do a lot of tech companies fail? Yes, a lot. Around 80% of companies that VC found end up bankrupt, or both for the price that was put in, right? They do not make money. So that checks out. Good investment thesis, it seems. Second, can VC beat the market? Well, that's more complicated. Remember, we want more than 3 times the money put in. Only 5% of VC do that. And the vast majority return far less than that, which means that everyone that put money in lost money, because that's money that could have been made to work for 10 years. What? I thought this was about making a lot of money. Something is wrong here, because 5% is not a lot, and 95% losing money is really bad. Okay. Maybe at least this company can become profitable, right? I don't know. This is where I show my bias. Looking at companies recently, all the ones that IPO, that get acquired, none of them seems to have any plan or idea if they can even be profitable one day. Example, Uber, PagerDuty, Neuralink, NPM, GitHub. Tell me one that did profit. Really, I would like to know which one, because I can't find one when I search. At least not in the past 5 to 10 years. Airbnb not making money. GitLab just released their IPO demand, their S1 today, and they make more loss than they have in revenue. So they're definitely not profitable. It seems we have a lot of companies that lose money and keep asking more money from investors with no idea how to make money. And I don't know what to say. I would like to be wrong here. So if you find some, please tell me. But what? Like, we have these companies that fail a lot, that return really badly. Only 5% make money. 5% of investors, not of company, of investors make money. And on top of that, the company are not even making a profit. As a capitalist, I have to say, what? Okay. Can we at least explain why they can't become profitable? Well, interestingly, despite the fact that none of them make a profit, they keep the investment round, the Series A, the Series B, etc., keep having more money poured into it. A Series A for this year is probably 500K more than last year. And we used to have Series A's that were 1 million, and now a Series A is regularly 5 to 20 million, despite none of these companies making money. So people are ready to pay far more money to get something that makes no money. What? Okay. What is happening here? So there is a few things I can point out. So Jean-Pierre has a question. Wouldn't that description pretty much fit the definition of a pyramid scheme? No. And the reason for that is because in a pyramid scheme, you would use the money of the newcomers to pay the people living. But that's not the case here. The people that put the money in lose it. They are not getting paid. They know they're going to lose it. There is no money for them. So it's not exactly that. Like, that money disappears. And they know that. And they still go with it. Which, is interesting too. But yeah, but they know it. Like, these numbers I'm showing are well known, and these are investors, these LPs, are people that do that as a job, right? That's a job. So, and like that's a job to create really complicated financial product and to interpret it. So probably not. But we can come back to this. So what is happening? Well, there is a few things I can point out. At least I can point out as some of the reasons that makes some of this happen. Not all of it, but some of this. Right. So what could we say? Well, first, let's go back to 20 and 2, right? Because GPs are the ones that decide to invest this money, so they have to have something here. 20% of the total profit, well, they are not making money. So that probably kind of zero, right? Or not high at least. And honestly, this is bad. Like if you talk to someone that do finance and accounting, money in 10 years is pretty bad, right? If I am a GP and I want to buy a house or a new boat, or I want to pay for my kid to go to college, I want the money now, not in 10 years. 10 years is nice, but that's really, really far. 2% yearly of the fund value, that's what pay my salary, right? The 20% is a nice bonus if that happens, but that's money in the future. When in the future is bad, I can't invest it. I can't do anything with it. 2% yearly of the fund value is based on mark-to-market value. Wait a minute. What does mark-to-market mean? Let's have a look. So this was our plan, right? We do a funding round, we wait 10 years, we help them, we liquidate, and we get money with a markup, right? And we return a profit. Well, that's not happening, right? We know we are not returning a profit, we're not getting really money with markup, but the liquidation event do happen. So what's happening here? Let's look at the plan from a GP point of view. Seed. So let's say, hypothetically, this is not real money, right? This is not real values, but that's good for simplifying the math, but that's how it works with just bigger numbers. Let's say I get 100 shares in this startup at $100, which means I paid $1 per share. Okay. So I got, basically at that point, my only fee is just 2% of the money that was put in early, right? Because I bought for $1 one share that is worth $1. So my value on the market is the one I paid, right? That's how we decide the value of something that we have not sold yet. You compare to the equivalent thing that was already sold to the market, and we sold for $1, so that was $1. And the company grow at X% per month, right? So it grows, spending money growing, right? Because remember, you spend all your money to grow, and then you don't have money anymore. So you do a Series A. But this Series A, you grew. So you know you are going to grow, you have a bigger user base. So this is less risky, right? This is a base that's already worked for a long time. So you can sell it for more money, right? Because there is less risk and you know the user base. So now you sell 100 shares for $200. That means that there is $2 per share. That means that the shares that were sold in the seed just went from $1 to $2, right? Because that's what people pay on the market, so that they have value marked to market. So the 2% were 2 cents per share yearly. It's now 4 cents per share yearly. And with real number, you just paid the new cars, the new Teslas of that GP. Nice. Everyone happy. My company as a founder got more money to invest. We grew, so we have grown. We are a big company. And my previous investors already are making money with it. Nice. The LPs are not making money with it yet because the shares are still not sold, so no one knows if they would really buy them for that price in liquidation. But my GPs, my VCs, are making more through that yearly fee. And then I grow at 2x per month, or maybe 3x per month. Why? Well, because I have more money. Series A's tend to be bigger than seeds, so I can spend it faster to buy growth. Like I can put a lot of ads on Twitter, on Google, on Facebook. And the other reason I grow at 2x a month is that my Series A investors bought me when I was growing at X% per month, but they bought me for $200, which was more than the previous one. So they expect more out of it. They expect bigger growth. So hey, everyone's happy, right? At some point, I got out of money too. And probably at the same speed because I spend fast. I have more, but I spend faster. So I probably a year, another year. Now I need more money. Let's do a Series B. Let's do a B. And now, well, I grow faster and I have one more year and I have 4 more customers. Let's sell the shares at $400 for 100 share. And now that's $4 per share. The seed share went from $1 to 4, 2% became 8 cents. And the Series A also gets the 2-time multiplicator. So they went from 4 cents per share yearly to 8 cents. Everyone's happy, right? And I got more money because Series Bs tend to be bigger, so I can grow at even more until my next series, because I still don't make a profit, remember, so I lose all this money, etc., etc., etc. That's a lot of dollars. So if we look at this that way, from a GP, the plan is just to keep getting more investors to raise the value mark to market. As long as we grow faster every time, we need to grow faster every time, otherwise our values stop growing, right? Because remember, the more you grow, the more you will become the winner, so the more important you are. So this is really about growth, right? From the LP point of view, what happened here? Well, what happens is that the shares went from $1 to 2. We just 2x'd. Right? We just did a 2x to the value of the fund. So that's great. And only after a year. So let's say you spend a year to find the startup, and then a year after you get the Series A, 2 years, 100% return. That's nice. Is that better than the 12%? This is a fund going really well. Okay, it will only pay in 10 years and a lot of things can happen, but so far, the numbers are amazing. 2x in a year, maybe 2 years. That's great. Remember, when we talked at the beginning, this VC do a fund regularly. They don't only have one that they keep for 10 years, they have one for 10 years, and then a few years after, they start a second one for 10 more years. They just 2x our money. Let's give them more money because they know what they are doing. Right? Maybe it will not work in 10 years, but right now it looks amazing. Let's give more money. Everyone's happy, right? Now, that doesn't explain everything. There is a lot of other things at work here. The fact that the LPs need to spend their money somewhere. They have a lot of money. So asking more money from them makes sense for them. There is a lot of stuff here, but that's a pretty good understanding of how the GPs look at the world and how they act it. And the reality is that the GPs are the ones that decide who get money, right? Which company, which startup get money? What kind of software do we build? What is important in the software we build? Because they're the ones that found it. If you can't find funding, you can't build it. So this is something to keep in mind. From the GP point of view, this is how things work, right? The more you get investment and the faster you grow, because that's what all the VCs think is important, the more they get money. So that's important. If you explode in flight later or do not help society or anything, it doesn't matter. They got them money anyway. Now, does that mean they don't have ethics, so they don't think about it, but they still are in a system that gives them a big incentive to not do that. Final thoughts. I don't know, mate. I don't know. I don't know what to tell you how to change that, or I don't know what that's going to, what we can do about it. Not exactly, but I think it's important to understand how the system works, because this is what decides what we build and how. If there's one thing to keep in mind, is that if you want funding or if you want to build software today, you have to have a software that grow. This is the most important thing. Everything else do not matter. Profit do not matter. Growth matters. A product that people want and use do not matter if you can get growth. And you can get growth in a lot of ways for a product that is bad. Growth is all that matters because that's what makes money. So that's basically what to keep in mind if you want to understand VC. I don't know how exactly why all this makes sense or why we do things that way. I mean, I have some ideas, but that's the first start, is to keep in mind that there's a lot of question mark here, and I would love to talk about them. Understand how the system works, because this is what defines what we can do and what we build. And if you don't understand how the people that take the decision are incentivized and rewarded, you can't understand why they took the decision, how they get there. And so it's hard to influence them. And growth. This is all that matter for tech, because that's what our people that found us want, to make money. That's the end of the road for this talk. Hope you enjoyed it. If there are more questions, I'm happy to take them and talk about them in the stage or after in the lounge. Thank you very much.